Probably something you've all noticed. The market just continues to go up. There will be a little bit of a change today um, in kind of my long-term view of where I see things going. So we'll talk a little bit about that, but let's just jump on in. So you'll see, as I said, the market just continues to go up. There's a lot of factors for why that is. We'll talk about kind of the economy, what's driving that, what's driving the need for the Fed to cut interest rates. So we'll get into that in the future. But I do suspect, as far as the market goes, that there are a couple things we're going to see. One, the valuations of the stock market have not changed. We're still way overvalued in the stock market. And that's part of the printing of money that's occurred over the last several years. 37 trillion in debt that we have. It's driven this market up to where when interest rates were low, there was no quote unquote safe place to put money because treasuries were paying 1%. If anybody wanted to get a decent return on their money, they had to put it into the stock market. And so that was one of the purposes of the Fed cutting interest rates, was to push that money into the market. And at some point, we need to see that money start to come out. And it's not a one for one where when the interest rates start to come down, that again, that creates a need for people to go into the market. What we're going to see most likely is the stock market coming down and earnings going up, which is the biggest change and the biggest surprise I've seen over the last 6 months. Is we're seeing earnings go up. People are spending money, they're buying things at companies, and it's driving the earnings of the companies up. So when you think about valuation, you have the earnings that the company receives, and then the multiple on those earnings, or the amount of years that it takes to get this earning to equal the value of the actual stock. So historically speaking, approximately 15% or 15 years is the amount of earnings it takes to equal a stock. And we're up in the mid to high 30s right now. So that's more than double normal. And that's only happened a couple times in history. So if you asked me 6 months ago, a year ago, I would have said I thought we were due a 50% drop in the market. And that's still a possibility. However, what I'm seeing is earnings growth is speeding up. And we may have a combination of the market coming down and earnings coming up to meet in the middle. So I still think we're going to have a significant double digit drop in the market at some point, and it could potentially happen this year. It may not, but that's all driving a few investment changes that I'm going to suggest we make over the next month. So that was the S&P. Treasury yields, you'll see they've come down off a peak in the May-June period. Again, that's happening because the Fed is talking about cutting interest rates. They're actually, the estimate is they'll cut in their next 4 successive meetings. If they do quarter point cuts, that would be a full point over the next 4 meetings, which 1 point or 1% cut saves the US over $300 billion in interest each year on their treasuries. So it's a pretty important move as far as paying down debt to cut the interest that we're paying on an annual basis. So we should see those numbers, the yields continue to come down. And what that does is drive the value of the bonds up. And so we should see that. As we've talked about, I don't see any change in this area through the end of the year. And when I mean I don't see any change, I don't see any change versus what we've been talking about the whole time. JP Morgan says it now sees the 4 Fed rate cuts that we talked about. I've actually seen as high as 6 successive cuts. So the general consensus is that we'll at least have a cut in September, and that we'll continue to see cuts through the end of the year. Here's an interesting chart on the share of jobs. So you'll see the green is government jobs, the blue is private jobs. So in 2023 and 2024, on average, over a quarter of all jobs created were government government jobs. In many ways, that was artificial because there weren't any added government agencies or anything there. It was just kind of padding the numbers, unfortunately. So if you look at today or 2025, 100% of all new jobs being created are private sector jobs. Private sector jobs are important because they're the ones that actually drive up the everyday employee's income. And we've already started to see, I want to say it was about 1,500 of annual increase that the average American will see this year. That's versus inflation. So although inflation continues to move up, and by the way, it's at historical norms, it's not at the inflation levels we were seeing a year ago, 2 years ago, 3 years ago. It's normal inflation levels. But what we've seen over the last decade is inflation goes up and earnings don't. And so the amount that you actually take home goes down over time. So this is one of the first times we've seen the amount that you're taking home go up in several years. So the fedometer is staying the same, kind of pegged in the middle. Like I said, I think in September we'll see that move and we'll start to move towards a more aggressive Fed policy. So we talked about inflation numbers. The government number came in at about 3%. 2.7 is what it's showing on this chart. The trueflation number, which I would argue is a much more accurate number because it takes in more information points than the government number, is much lower. And you'll see the trend since July has been, for the most part, down. And if you look at the trend since January, it's way down. So I anticipate that we'll keep on that trend. One of the big fears, one of the big talking points has been tariffs. So far, knock on wood, tariffs have not affected inflation at all. So hopefully that continues to be the case. Gold, that's not a bad year return on gold. One thing that I would hazard, because we've gone up so much in gold over the last year, over the last 3 years for that matter, is that it seems to be kind of peaking. That doesn't mean it won't continue to go up, but I do believe that it's slowing. And one of the things that I'm hearing is that Bitcoin is starting to replace gold as a stable asset and a inflationary asset. And there's several reasons why. One is if you have $1 million in gold, it's going to be hard to walk around with that. You have the weight of gold, obviously. Number two, it's very easy to steal. It's a physical item. It can be taken easily. Number three, it's not transportable across borders. If you walk across a border with a bunch of gold, you're going to get stopped and most likely it's going to get confiscated. So there are some impractical parts of gold that you don't have with Bitcoin. Bitcoin has no weight. It's because it's a digital asset. It's not easily stolen. And blockchain in particular, because it's a ledger on hundreds of thousands, if not millions of computers, someone can't just hack in and take your Bitcoin because it's your Bitcoin shows up on the ledger in so many different places. Whereas, say, your bank account, somebody can log into the bank, get into their servers, and change the name on the account to themselves. That's an oversimplified way of looking at it, but that's kind of the framework of why Bitcoin is starting to replace gold as one of those safe haven assets. Silver did not move as much over the year until the last 4 months or so, and it's sped up its acceleration. I can't remember when it was, but we talked about silver potentially getting up to 40 this year. So we're getting up there. We may exceed that. So kind of a review of what we talked about the last couple calls. Big bad tariffs, as I said, we're not seeing the inflation that was expected, prophesied. It just hasn't materialized at this point. So we've started to have tax cuts. So one of the big things that drives the economy is tax cuts. Every level of American should be able to benefit from the tax cuts. So in California in particular, if you own a home, the SALT tax has been moved from 10,000 to 40,000. So the SALT tax is state and local tax, which you were capped at 10,000, being able to write that off. So you weren't federally taxed on those dollars. Now that's moved up to 40. So that for a lot of people, just their property taxes are 10,000. So any state income taxes would have been double taxed, basically. For folks over 65, you have the added 6,000 of deduction, which should theoretically, in most cases, make your Social Security tax-free. So that should be a help for the working class. The standard deductions were moved up, and overtime to an extent and tips to an extent have been rendered tax-free. So for the working class, all the way through to billionaires, there are some benefits to everyone. But ultimately, what it means is everybody should have more dollars in their pocket at the end of the month than they did previously.
Can I ask a question? The over 55, what percentage was that, or was that an amount?
Sorry, over 65.
Over 65. And what was that amount or the percentage?
It's a $6,000 deduction.
Okay.
Yeah.
And all these are all now currently in place and effective?
I don't know if you'll find them in, say, tax software yet, because it's for year 2025. But
Okay.
yes, they are enacted now. When you file your taxes, you'll be able to use those deductions for this year.
Okay, thank you.
Yep. Deregulation. So one of the biggest things that is helping the economy and maybe offsetting some of the job cuts that we're seeing specifically in the government is deregulation. Basically cutting all the red tape that holds projects up, holds building permits, all of those sorts of things. So we're seeing that projects that would normally take a year might take 3 to 6 months now. And that's kind of the rate things are speeding up at. So anytime you can have money move faster within the economy, that strengthens it. So we see that happening. Reduction of wasteful spending. I do see that we've slowed down a bit in that area, but we're making progress, and what they're working on is creating laws rather than just cutting spending, but creating laws that mandate certain spending cuts, or at least mandate explaining why that expense is important. So we're getting more of that. And then again, the interest rates and Fed policy, we're likely to see a Fed cut next month. And as the market anticipates that more and more, you'll see the stock market go up and you'll see long-term treasuries go up. Historically speaking, when the Fed cuts rates, it usually takes about 12 to 18 months till the market hits a bottom. Again, originally we were talking about maybe a 50% drop. Now I'm thinking 25 to 30% is more likely within the range we're looking at. Okay. Any questions?
Yeah, Matt, I have a quick question for you about the jobs report. If there is an erosion of trust on whether those numbers are accurate or not, how will that impact us making our financial decisions moving forward?
Well, I don't know if you remember, but I've been talking about this for over a year, that the jobs numbers coming in are just not real. They come out with a big number and then they revise them down in the Friday late afternoon, so it never makes a media cycle. This has been an issue for a long time. That being said, I think that issue is being solved as we speak, and we'll have accurate jobs numbers, maybe not in the next reporting, but going forward, we'll have all of that cleaned up. But as far as how does it affect how we invest and everything, I don't really think it does. If we see that we have a huge negative jobs number come in. Obviously, that's weakening the economy. And right now, what they're trying to do, the 5 things we just talked about, is balance all of those. So Fed rate cuts help the economy, cutting spending helps the economy, all of these different things. And so maybe tariffs make things more expensive, but other things like cutting taxes make it so you have more money. So versus inflation, you actually end up with more dollars. And so they're trying to balance and do a little bit of each thing as they go to not create that tipping point. So
Okay.
I would think in every jobs number that I've looked at that's not reported by that specific agency has been fairly accurate, it seems. And
Okay.
so what I'm seeing is huge investment in the country, jobs being created. Many of them are future jobs at this point, where we've got tens of thousands of jobs once a factory is created or something along those lines. As far as I can tell, it looks like the jobs numbers are good and will continue that way for a while.
Okay. Thanks a lot.
Yep. Any other questions? Okay.
Well, best of luck to you and your family at the horse event.
Thank you.
Yes. Good luck.